Welcome to the Daily Update. This is Being Prepared Wednesday, May 4th, where we'll look at the action in the market today and then see how things look for Thursday, May 5th. And it was quite a day. Few people were probably surprised that the FOMC came out and made an announcement, and then the market had a big reaction to that. Pretty much everybody saw that coming. It was just a matter of what direction will we go? Well, we ended up being positive. The S&P was up strong, as were the other stock indexes, and we've improved things quite a bit, but we're still negative overall. We've got a lot of work left to do. One thing that I want to mention before I get started is the last couple of days, I apologize for posting the videos later than usual. Some of these things were out of my control. Others were just, I was taking too long to prepare things. And as I work out some different ways to present the information to you, sometimes that takes me a long time to do that. But one thing I want to mention also is you do have access to the slides that I use in the video, as well as all of the slides that I look at. What you can do is go to spxinvestingblog.com, and all the slides that are used in each day's video can be viewed, downloaded as a PDF, or saved individually in any way you want to use those. I also upload other slides that are not used in the video, but I look at those each day. You can also view those and save those. I don't have a PDF of that. I need to go in and figure out how to do that in Adobe Acrobat. So let's go back and talk about Wednesday, what happened. At the open, we had a positive open, but it kind of quickly turned negative. We were above the daily pivot. Then as the day went on, selling took prices down to S1, 41.48. It's almost like the first part of the day doesn't even count. It's what came later in the day, and that's typical for an FOMC day. Then pre-announcement, prices went back positive because we saw some buying come in, and we saw a little more action than what I usually see. Typically, we'll gyrate a bit at the open, and then it's pretty much flat with an upward bias until the announcement comes out. But, hey, every day is unique. Then, after the Fed made their announcement, we had a real crazy reaction, and I have a chart to show you of that. At the close, late-day buying took prices above R2. We were off to the races, and that was at about 42.27, and then finally, we worked our way up to 4,300, which, since that's a round number, there's a lot of strike prices there. It's psychological. It's something the financial media likes to point out. Well, that was pretty much where we topped out. We got a little bit above that, but that was the main level that we hit. We closed almost at the high, and we were up 2.99%. Pretty healthy move. It seems as though the sell the rumor, buy the news scenario was viable after all. Volume ended up being above average, and the technicals, although we're seeing a lot of improvement, and I'll show you those charts, we're still negative. We've got a lot of damage that still needs to be repaired, but we're looking much better. Of course, now the question is, can this continue? The markets are still going to be fixated on inflation and interest rates, the different geopolitical concerns that are going on. Earnings are still coming out, which can either shoot things higher or lower and spread over into the entire market, or sometimes just stay confined within an industry group or even a sector. What are some comments that we can make? Chair Powell came out and said that a 75 basis point move is not very likely going forward from here. A lot of people were concerned about that. Because inflation has skyrocketed so quickly, and as I point out in my videos, the official rate is about 8.5% inflation, where in realistic terms, the way we used to measure it, we're over 17%. So going from 0.25% to 50 basis points higher to 0.75%, it's like, yeah, are we really even doing anything here? But this seemed to calm the markets down a little bit. He said that 50 basis points are more likely at the next two meetings. That would be in June and then in July. And they're 6 weeks apart. So one's kind of in the earlier part of June. The other one's at the end of July. And that they will start a tapering plan. And I'll go through and talk about that here in just a moment. The technicals are negative, but we're seeing a lot of improvement. we were able to recapture a lot of pivot levels, not only in the S&P, but as well as some other indexes. We regained that intermediate term support, and I'll show you that on the chart. But there was one thing that was kind of concerning. Now, on one hand, this makes sense. We didn't see a real expansion of new highs. In fact, we saw a lack of new highs for a 3% move. But at the same time, we've been here before. And there's been a lot of damage done to the market. So even though prices went higher, the fact that we didn't set a lot of new highs is a little bit concerning, but not a major red flag. But we'll want to keep watching it from this period forward. The staples to S&P ratio, that spike is looking a little more viable right now. And I have a chart right at the end that I'll show you that. Heating oil and gas. Gas seems to be spiking right now, where heating oil is rising. And I'm also really seeing a real increase in diesel prices. And I have a chart where I'll show you that. The S&P is still in correction territory. That hasn't changed. The 10 to the 5, they're now even. You want to plop down and buy a 10-year bond or a 5-year bond, you're going to get the same rate of return, at least as of the close today. The economic reports that came out, the ISM non-manufacturing index, it decreased to 57.1. They expected it to be at 58.7, so that was weaker than expected. And from 58.3 in March, the previous report. When we're looking at these types of measurements, if we're above 50, that is expansion. That means the economy is growing. If we go under 50, that means the economy is contracting or shrinking. Well, even though it was weaker than expected, we're still above 50. The trade deficit, it went to a record high. And the ADP employment change report, they estimated that we had 247,000 new jobs. Now, the big employment report is coming out on Friday. This is released a few days before. The final IHS Market Services PMI increased to 55.6, up from 54.7 that we received in the preliminary reading. Kind of a big thing, but not a real major mover. In fact, when this came out, I thought it was going to be a market mover, but the markets didn't really even pay attention to it. Then every week we get the MBA mortgage applications index. It increased to 2.5% following an 8.5% decline last week. Our trend, it's still negative, but it's weakening. And I'll go through and show a chart of the ADX. Our bias remains positive. We've had 3 up days in a row now. Imagine that. Our momentum, though, is still mixed. There's still a lot of negativity. There's still a lot of technical damage that still needs to be repaired. It's not negative, but it's not full-blown positive yet either. So a tapering plan, what the Fed said is starting on June 1st, the cap or the high point for treasuries, when they're getting rid of these, they're going to start selling them and letting them expire because the treasuries have maturities and they'll just let them go at the end. It will initially be set at $30 billion per month and then increase to $60 billion after 3 months. Okay, so that's what we call tapering. And it's kind of good that Chairman Powell came out and said this because, well, this is going to produce enough freak out as it is. But for the markets to guess and then for him to come out and say, okay, this is what we're going to do, that gives the market some more certainty to act on. Then the cap for agency debt, and I'll talk about that again in just a second, and mortgage-backed securities, or MBS. That'll be set at $17.5 billion per month and then increase to $35 billion after 3 months. So they're going to start winding down a lot of these things that they bought. This was quantitative easing, when they bought all of these things to help stimulate the economy to produce a lot of fluidity into the markets and basically create money out of thin air. Well, now that we're seeing a lot of inflation, they're going to start getting rid of some of these things and hopefully helping the money supply so there won't be as much out there and that the dollar will be able to maintain some value. Now, an agency bond that was referred to here, that's also known as agency debt, and it's issued by a government-sponsored enterprise or the Fed, or the federal government, other than the U.S. Treasury. they're usually not guaranteed the same way that treasuries are or that municipal bonds are. So you typically get a little bit higher interest rate on that because there's a little bit more risk involved with those, because treasury bonds are considered to be the safest investments there are. Of course, if you're holding a bond at 2% or 3% and inflation is 8.5%, okay, you're going to get your little 2 or 3%, but you're losing money overall when you compare it to inflation. Most, but not all, are exempt from state and local taxes. So that's, if you ever hear the term agency bond or agency debt, that's what they're referring to. I tried to find some information about corporate bonds that the Fed had been in purchasing, but I haven't really found anything good about that yet. What is their plan for corporate bonds? Which is a very strange thing to do in the U.S., where you have this republic based on freedom without a lot of government interference. At least that's the way it was designed. And they come in and they start buying bonds. That's one of the tenets of fascism, as I point out in one of my videos. And so that's a little scary to some people. And in fact, the tapering that we're seeing now, the quantitative easing, back in 2008, when this kicked in, people freaked out about this. It's like, my gosh, just let the economy crash. Yeah, people are going to lose money. People are going to lose their jobs. People are going to be hurt. But short-term pain, long-term gain. Well, we have this too big to fail type of approach now. It says, no, the government is the answer when anything goes wrong, and the government needs to step in and try to fix things. And there's a side to take. Some people think, nope, laissez-faire, stay away, get away. That was more what Ronald Reagan really promoted. The other side that says, well, people are homeless, people need food, people are losing things where they're victims. They didn't go out and lose this themselves. They're actually seeing their life savings or their business go down the drain, and so somebody should step in and help. And you have two sides to that argument. Nonetheless, getting back to the market. Year to date, the Dow is now down 6.3%. The S&P is down 9.8%. The Russell, or small caps, are down 13.2%. And the Nasdaq is down 17.1%. So still down overall, but looking better after the Fed made their announcement. We did see a bit of a decrease in fear. So our gauge went up a little bit. And I don't know what these numbers mean over here. It's different than when I did the video yesterday. But we're still looking at a lot of fear, just not as fearful as we were. Here's the long-term chart. I'm going to try to use the mouse a little bit more. In yesterday's video, I just did it all hands off, and I don't like doing it that way. I'm also trying to set things up so that I can use an actual mouse instead of a mouse pad that I'm using right now. Then the VIX did really decline on a closing basis on the line chart, and also declined and closed near the low on the bar chart. The VIX of the VIX, that measures how volatile is the VIX itself, it really declined, both on the bar chart as well as on the daily line chart. The Ulcer Index continues to advance slightly, so it just shows that fear continues to increase. And here's the longer-term chart of that. The equity put-call ratio is still coming off of an extreme fear reading, but it's coming down nonetheless, but it's still pretty high when you go back and measure the last 5 days. Now, inflation, I just wanted to bring up the CRB. Over here on the left, it shows the different areas that this index measures, and this is where I get a lot of my inflation stance from. We were up 2.44%, and we've been in a really strong uptrend. Then gas, it's starting to get a little bit higher right now. It looks to be spiking at 3.65. And heating oil, not quite as high, but is still really shooting up at 4.2. Looking at the sectors, everyone was up. The energy sector, which had been doing quite well, is probably the best sector of the year. Not probably, it is. It was up over 4%. Tech was up 3.5%. Communication, a lot of the things that have been getting hammered. The one that performed the worst was real estate, and it was up 1.18. Here's a graphical look at how the sectors have been performing since the all-time high, with energy way in the lead. Utilities doing fairly well, staples. Then way over on the other end, even though we saw a nice bounce, communication, discretionary, and tech are leading up the rear. Then going through some of the other blog charts that I get from IsabelNet, this just shows buybacks. And what we see in a real healthy environment, a company will go in and buy its own stock. And that's known as a stock buyback. That not only produces buying, which can push prices higher, that also makes less shares available to the public, and that also makes them more precious, which can push prices higher. This just shows buybacks by corporate clients peaking after recent highs, and there's a 4-week average right here. And we really saw that spike up in 2021. Well, it's really been coming down lately. So we're not seeing as much buyback activity as we were before. Another chart, and actually that little red arrow there I drew, this is just showing that we expect that a shrinking contribution from goods inflation will slow the core prices that you have to pay, inflation, to 3.9% by year end. And that's according to Goldman Sachs. So they see inflation tapering off. Take that for what it's worth. They also are suggesting that it will continue to decrease into 2023 and 2024. Goldman Sachs also comes out with their predictions with where do they think Treasury yields will be on the 10-year. That's the benchmark. Yes, there's a 30-year bond, there's a 20-year bond, but most countries have a 10-year bond. So if you want to compare apples to apples, you compare 10-year Treasury bonds and yields. Where right now, at the time this was made, we were at 2.87. We're getting right up to 3 right now. And they pretty much are expecting it to be about 2.7% in 2022, 2.8, and then back down to 2.7 in 2024. These are just forecasts. This is like looking into a crystal ball, but people like these kinds of things and sometimes use them to make decisions. Then this is also showing sentiment with a 4-week average of this in the buy the dip zone. That's one of the things that people really learn quickly, it seems. When you're new to the markets, buy the dip, buy the dip, buy the dip. Well, that works fine as long as the dip turns into a bounce. But if you see what we've been seeing lately, and I'm in a lot of groups and I kind of watch other people making comments, they're freaking out because they bought the dip only to see a 10, 15, 20, 30% loss now in something that they got into, and they're not really happy and they're like freaking out. And it's like, welcome to the stock market. Everybody's a genius when it's going up, but when things turn, that's when people really get into trouble. And that's why I teach in my program all different sides, up, down, sideways. And we can take advantage of all of those. But looking at this chart, it just shows that we're getting extreme down here, where we're using this as a contrary indicator. And there's also the AAII survey thrown into this, which just shows that sentiment is getting overly pessimistic. Then Fed Watch, we can take the May meeting off the table and now look at June. I'll probably not show these charts. I'll post them every day on the blog, but I won't talk about them. I just like to go over them since the meeting is over. And right now, there's an 85% chance that we'll be at 1 to 1.25 after the June meeting. Here's a historical chart. Then at the late July meeting, there's an 81.1% chance that we'll be at 1.5 to 1.75. And here's the historical chart there. Technical alerts, saw a whole lot of them. And starting at the bottom and then working our way up, the NASDAQ saw a lot of good technical alerts being triggered. It did start off a little bit negative where the NASDAQ fell below 12.5 and then 12.4, but then it got back up to 12.6. Nothing really with the S&P until we get to the point of 4,300. Oil was able to get back above 105. Intraday, here's the chart that we usually look at where it just shows we had a slightly positive open and then quickly went negative. We dropped all the way down to S1. And these resistance levels and support levels are so close to each other because they're based on the previous day. And we didn't see a really wide range on Tuesday. So that's how come we were able to get to these levels so easily. We never did get to R3, but 4,300 ended up acting as resistance. And that's what happened. We gyrated all around for about 30 minutes or so, and then prices just took off. And here's a 1 minute chart. This is what I brought up on my screen, and I was following it right here at 2 p.m. Here's when they made their announcement, and prices go all crazy. They go down, they go up, they go down. And then the press conference starts. And then they really liked what they were hearing during the press conference, and that just took us off to the races, and we closed just a little bit off of the high. So it was a pretty positive day there overall. And then we were able to get back above this intermediate term support. The long-term support held. That's very positive. And then to have this intermediate term support, we got back above that. Now, can we hold that level? We also got back above a pivot point as well. And my mouse thing is just going all over. It's like it just has a mind of its own. And then it just vanishes. Sometimes then I have to jiggle it all around to get it to come back. Anyway, so this is looking better, but we're still kind of vulnerable right now. We're way below our moving averages. Our oscillators are still negative. So there's a lot of damage that still needs to be taken care of. But this looks better than it did. And you can see where we were above average with the volume. We're down 10.35% from the all-time high. And then looking at our technical overview here, these are things that are outperforming. And this, believe it or not, has not changed. We need more than 1 day for these things to change. Value is still outperforming growth. Growth is outperforming bond prices. The 10-year interest rates are still outperforming tech and the S&P. The low volatility stocks are outperforming the rest of the S&P stocks. Energy is outperforming everything, it seems. Energy is also outperforming tech. And commodities are outperforming the S&P. Gold is outperforming the S&P, and staples, the things that you have to have, is outperforming the things that you don't necessarily have to have. And junk bonds are outperforming treasury bonds. Then those things that are positive, and we have a little bit longer list now, but let me go through these first. Energy is positive. CRB is positive. Gold. This is the same. I haven't changed this. Where it's really interesting is when we look inside the S&P to see how things are shifting there. The areas that are underperforming, the growth stocks like the NASDAQ 100, they're still underperforming the S&P 500. The S&P 500 is underperforming interest rates. Growth is underperforming value. Tech is underperforming interest rates and the S&P. The S&P is underperforming commodities. The S&P 100, the big growth companies, are underperforming S&P 500 companies. Discretionary is underperforming staples. Okay, here's where we're still a little bit negative here. The Dow Jones, we've got some damage that we still need to do with the Dow Jones Composite. World indexes, but they're improving. Junk bonds are looking a little bit better. The FANG index, these are still negative because we bounced and we had a good healthy bounce, but can it continue? All of these things had a pretty good day, but they're still negative overall. Now, looking at this, our negative signs, and you're going to see it's like a rainbow going on here. What are those indicators that are negative? And we're still heavily negative. Looking at all time frames, we're below all the moving averages. The moving averages continue to decline because we're below that based on price. The advanced decline studies based on volume, it's negative but improving. That's why we have it in blue. And the chart variations are also showing some improvement. Short term, the Stochk RSI is negative but improving. The Williams percent R, it's still giving us an oversold signal. Intermediate term, the rate of change looking at the 10, 20, 50, and 200, it's negative but improving. PMO based on price and volume, negative but improving. The PMO of the buy signals is still extreme, giving us an oversold reading. The PMOs that are above zero, still declining. That's why it's in white. The momentum indicators, negative but improving. Parabolic SAR, negative. Actually, that's not true. That should have been switched to positive. We actually had a positive signal on the parabolic SAR, so that's a mistake. The stochastic studies in the intermediate term are giving us an oversold reading. Longer term, they are extreme negative. The 50 period, 150, and 200, the longer term moving average study, they're still negative but improving. The new highs and new lows continue to decline. The Sean trend meter is negative but improving. the BPI, the CCI, the CMF, ease of movement, money flow index, ultimate oscillator, vortex, and I don't know why I'm using a different shade of blue there, but they are negative but improving, and that's a lot better than it was just yesterday. The Summation Index based on price is still declining, but based on volume, it is improving. Accumulation distribution continues to show, but it is showing some improvement. Our Ichimoku cloud is still negative. The boom indicator is still extreme negative, but on the 200 is still declining. And the percent B, as well as the RSI on 14 periods, is negative but improving. Long term. I don't know if it's better to try to talk about these things or just put this chart up and just not talk for a minute and let you look at it. I don't know. Any feedback would be appreciated. The special K is continuing to decline. The rate of change in 200 is still negative, and the long-term trend is still declining. And it takes me quite a bit of time to update this thing. You would not believe. And then I got to change the color, and I got to make sure it all fits on here, and then it loads in the right way. Oh, the agony of it all. But I like doing it. Positive. We have a much longer list now. It was pretty short the other day. The STO is positive. The Chaikin oscillator, that was on the list. The rate of change based on 1 day, because 3% moves are kind of an overreaction. So we may have done that on a short-term basis. We're looking better with the rate of change based on 5 periods. The 20, 50, and 200 EMAs are looking better. The advanced decline studies based on price are looking better. The 80 study ratio for 1 day, that kind of goes hand in hand with the rate of change 1. We just skyrocketed up. McClellan oscillator is looking better. The PMOs with the percent of PMOs that are rising is looking better. The S&P or SPY Elder Impulse System is back to being positive. The slope oscillator, it's our first oscillator to switch and go positive, and I'll have a chart of that. The parabolic SAR, which should have been taken off the other list, is on this list. Stochastics in the short term are positive. The force index, it actually went positive. Stoch RSI, this is our first extreme positive reading. This is a pretty temperamental indicator, so it can move around quickly. The Williams percent R, it's not extreme yet, but it is positive. The Summation Index based on price and volume is positive, and the accumulation distribution should have been taken off of the other chart and put on here. The RSI based on 9 periods is now turning up. And then the advanced decline, 19 over the 39 exponential moving average study, that is also positive. The positive setups, we actually have one that could be in play right now. The Copic curve, mass index, Pring bottom fisher, The small cap to S&P ratio that provides a thrust, The positive backdrop after an inverted yield curve, well, we're still a little bit inverted, and I'll talk about that. This is the one, the staples to the S&P spike. It might be happening, and I have a chart that I'll show you. So let's look at the trend. We are weakening. The trend is negative, but showing some weakness. We can see over here where the buying really did increase and the selling did decrease, and that could weaken the ADX overall until these two lines actually cross each other. The Arun still shows that sellers are in control and buyers are lessening. So this oscillator, it actually went sideways from yesterday's reading, but it's still negative overall. Looking at the breadth, this is what I was talking about. Here's the 19 exponential moving average against the 39. And we were able to cross back above the 0 line. So that is positive. This is the 1 day advanced decline ratio where we just skyrocketed up. That's a pretty big move. Intermediate term, still kind of negative to neutral with decision point. Here's the 1 day rate of change, just skyrocketed up. So we may have overdone it. But this thing will adjust from 1 day to the next. We might still see an up day and this could go down. Looking at 5 periods, looking a lot more positive. Back 10 periods coming out of an extreme negative reading. 50 periods just below the dashed line, which is 0, which once it goes above that will be positive. Looking at 200 periods, almost turning back positive. Here's a longer look at that same chart. Fib retracement, we're getting back above the 50% retracement level with the S&P. Then the standard deviation is starting to decline a little bit. So we're not getting too far away from the standard mean price. Here's the stochastics showing that we're actually positive in the short term, coming out of an extreme negative in the intermediate term and turning up at and giving us an extreme negative reading right now in the long term, or the full stochastics. McClellan oscillator went above zero, so it's turned positive. The STO, which has kind of been hanging in there, it's been kind of impressive with how it's given us some signs before they actually happened. It was looking positive through the whole mess that we saw over the last few days. Well, with the buying that came in after the announcement, it's just looking better based on price and volume. The PMO, looking better, but still negative. With the percent of PMOs that are rising, that is positive. It's above 50 and going up. That's the green line here. We're turning up with those that are giving us buy signals. We're flat with those that are above zero right now. The Chaikin oscillator, it was another one that was giving us kind of an early sign. It is positive and has gone above the zero line. The one that I'm focused on in this next one, this is the boom indicator. It's the 50. We're bouncing up out of an extreme negative reading. Here's the one oscillator that's turning back positive. This is slope, and it went down pretty deep. Could have gone down deeper, but it is starting to turn up. None of the other oscillators are doing that yet, even though they're showing some improvement. Our trading system, here's the Elder Impulse, S&P, positive. Spiders, positive. SAR, this is where the dot is underneath, and that was the mistake made earlier. I'll probably make mistakes every day in the video. There's just so much information to go over and so many places to change it that I often miss something. Point and figure, we drew some green X's right in here. There's no official signal that's been generated, but it likes what it sees so far. And then longer term, we're still below the long-term moving average, so that's still negative. The special K continues to decline. Broad market, the diamonds, positive. The Qs, positive. Based on the Elder Impulse system. The dollar, it was down pretty heavy, but it had been going up pretty drastically too. Here's oil, got back up to 107.81. Here's one that I found online. This is diesel. And I was listening to something, and they were talking about diesel prices, and I'm like, oh my gosh, this is what people have to pay to move things. This is part of the supply chain. And look at the price and how it's really spiked up. It's even higher than it was back in 2008 during the financial crisis. So we want to keep an eye on that. Bonds. We saw a bit of a bounce based on price. Here is the 10 to the 5 yield curve. They're at zero. They're like right on top of each other right now. So I don't know, is it inverted or not inverted? The treasury yields are coming down in the longer range as stocks went up. And then internationally, the one I'm paying attention to is Japan, but we've been seeing a real spike in the 10-year yields pretty much across the globe. Even though the dollar was down, it's still doing much better compared to the yen and the euro lately. I'm really hoping the euro and the dollar meet. I just think that'd be cool. I don't know why, but I just think it'd be kind of cool. Okay, our developing scenarios. Coptic curve, not happening yet, but turning up. Mass index, no signal generated yet. Pring bottom fisher, it's actually continuing to decline. And one thing, the deeper this goes before it does turn up, the better it might be. Not always, but sometimes that produces more of thrust when we finally get going in the other direction. At least that's been my experience. This is the one. This is looking viable. This is the staples. We've dropped down now the last number of days, and we're below the moving average. Could it be that we have spiked? So, if you're using this, you'll want to keep an eye on the staples sector. If you're looking to get in, watch that. See how it's doing. See how the S&P, of course, is doing. But we still have a question mark here, but this is looking like it could be happening. Of course, we could see everything switch and it goes back to just being another spike. but we kind of have to watch this as it unfolds. But we need, at least I need, other confirmation first before I'm willing to jump in. But this is a good sign, in my opinion. We don't know if we've spiked yet with the 2-year Treasury yield right now. It's still continuing to, well, it fell, but it doesn't look really spiky right now. The small cap thrust just doesn't seem to be happening right now. We're not really getting much from that, but that could change. So what's our outlook then? It's negative but improving. The markets remain in this intermediate term range. We're almost going to have to change it to a long-term range. Growth and value continue to battle back and forth. The economic reports coming out, not a real big slew of things. The jobless claims and then the preliminary productivity and unit labor cost report. Not real market movers. Sometimes the jobless claims can be, especially when we were in the lockdowns. They're not as much anymore. Geopolitical events, same list. Russia, Ukraine. China with supply chain issues. Inflation and interest rates. People are still kind of focused on that. Oil, earnings as they come out. Any Fed speak that you hear after the meeting now. And then this concerning look that we have towards Japan, that with their bonds and what might happen somewhere down the road. What are the different scenarios? We're still in a down scenario overall. Rising interest rates and inflation fears could continue to make things more negative. Earnings, Fed speak could freak the markets out at any time. The technicals are negative, but we were oversold and we're bouncing up out of that. So we're showing some improvement. Positive, a thrust bounce may change the negative tone. That's what we saw, up almost 3%. Is that going to be the beginning of more of an up move? The possible positive scenarios, the one that's looking the most likely is the staple spike. That's what I'm calling it. The technicals are still, they're improving, but they're still negative overall. We're below the moving averages. We regained a few pivots. We might get some support, which could also act as resistance. And then sideways, we're above 20. The ADX is starting to decline, and it's a negative trend right now. So what's our conclusion? The S&P is negative in a nutshell. Still, short term, negative, but bouncing from being oversold. Intermediate term, negative, but bouncing from oversold and showing some improvement. You could throw that into the short term category too. Our oscillators are improving, but they're still negative. We're still below a lot of really important moving averages. Long term, we continue to be negative, but because we're below the 200-day simple moving average. So thank you very much. I hope you have a wonderful Thursday, and I'll prepare the next report after Thursday's session.